Hello and welcome. You're watching KYC. Today we're going to talk about a very interesting company, Office Space Solutions. This one listed in May of 2024 has given a very strong return to shareholders. In fact, from the 383 IPO price, the stock currently sits at around 650 rupees a piece, which is extremely impressive in its own right. Let's talk about what I want to know about this company first off. And this is where it's very interesting. I want to first off understand growth. They have guided for a 30% growth FY25. They've done 42% on the top line. Can that 30% plus kind of growth clip sustain for a long period of time? That's the first thing I want to know. The second thing is with regard to how their model works on escalation and on retention. How many of their customers are they able to retain on a year-on-year basis as some of their leases expire, and what the competition really looks like in this current space and this current setup, because it's a unique business. It's more of a shared leasing office arrangement kind of a space. The third piece is with regard to occupancy and renewal trends. We spoke about renewal and that's where it again is very interesting to understand whether as some of their lease contracts expire, can they quickly renew those, and what is the kind of hit rate on those renewals, because you will have lease liabilities which will come through, and if they are not able to renew, that's a risk on the numbers and the financials of the company. Let's talk about mix changes. They currently do straight lease as well as managed office spaces. These are the two models. I will explain the models to you, but one of them has a very high return on capital and the other one not as much, because they have to do capex upfront. I want to understand whether that changes substantially. It hasn't over the last year or so, but if that were to change, you might well see some changes in terms of return expectations as well. How do you fund growth? They are a fast growing company. On their on their last year's number of seats, they've added 30% odd this year itself. They're going to add another near 30% next year. So how do you fund that kind of growth? What's the reasonable return ratio like? There's been large fluctuations, 25% in FY23 to 62% currently. What is that expectation, and what's the FY26 strategy like? So lots to talk about, because it's a very interesting company, and therefore I'm going to start right through. By the way, joining me today also is Anushi, Vakharia, who tracks this space, or more broadly the real estate space, and therefore will give us, of course, important insights on this company. Let's first start off with what the company does. It's India's largest and fastest growing flexible workspace solutions provider. I don't have to explain that. It's generally compared to something like a WeWork, but it's different, and I'll try and call out as to how it's different as this conversation goes ahead. There's a wide spectrum of flexible solutions, from an individual flexi desk to a customized office space. So they deal with end-to-end and different cohort of customers. They are able to cater to pretty much all cohorts. Let me take you through the journey first off. 2015 they launched their first center. 2016 they launched their co-working app. 2017 Peak XV invested in them. 2018 was their first center in a tier 2 city, and they're getting very good traction from some of these tier 2 plus cities. 2019 we saw investment by Chris Capital, again some marquee names coming through as the years have chugged along. 2021 they turned EBITDA positive and they opened their 100th center. 2023 100,000 seats, 5 million square foot managed. So those are two key marquee milestones which they crossed in 2023, and 2024 they signed a 165,000 square feet deal with NSE. So National Stock Exchange, the office of the National Stock Exchange is now managed by Office Space. So that's a large marquee deal which they did. Let me talk about size now. They do 134,000 seats at least at this point. So 134,000 operational seats. This number will likely go up by around 39,000 in the next year, which is FY26. They're currently present in they have 230 centers, which accommodates all of these seats. They're present in 18 cities. They have a blended occupancy, and this is impressive, of 73%. You have 73% of the entire capacity booked at all points. So this includes new capacity coming on stream, and mind you, a large part of that 134,000 operational seats which you see right at the top there, 39,000 of that has come in this year. So you have nearly 40,000 seats which have come in this year, and yet you have a 73% blended occupancy. 84% is their vintage occupancy. I have not mentioned that, but that's their vintage occupancy. That means that on 12-month plus, they have 84% of their seats which are pretty much occupied. Let me talk about tenure of agreement. They have a total tenure of 33 months, at least at this point, in terms of agreed, and 24 months of locked in. So 24 months is where blended, pretty much all their seats are fully locked in for at least a period of 24 months. Now let me talk about active clients. They have 3,000 plus active clients, 40% multi-center clients, and I talk about different locations, and that's why multi-center clients. So they have a good number of clients which have distribution across geographies, which allows them to continue to grow their geographic footprint as well. So they leverage on these to grow their geographic footprint. That's why it becomes very interesting in this line of business to have 40% of their clients having multi-centers, and therefore having that scope to continue to grow and giving them that platform to grow across cities as well. 53,000 new seats assigned in FY25. So that's again a very, very large number. Let me talk about the models they operate under. This is where again it's very interesting. You have two models. One is a straight lease where the owner pays rent regardless of occupancy. So you'll have the owner, which is office space, continue to make payments to the owner of the premises regardless of whether one seat is occupied or 100 seats are occupied. So it's a high capex model, high opex model. It's got better margins once it starts to hit a certain number. It's lower on its ROCE because the premises is taken over, and thereafter office space has to do capex to ensure that the premises is made in a good fashion to attract customers to come in. And it's a higher risk model because there is a higher amount of capex involved, obviously. Let me talk about managed aggregation, right? This is where again it's slightly differentiated, and this model seems to be doing much better. This is the new age model which they've come up with. Revenue sharing arrangement with the owner of the premises, low to no capex. A lot of times the owner himself has put up the capex. A lot of times there's very low percentage of capex which the owner bears as well as office space bears. So it's a lower margin business because you have to share some part of the revenue with the owner, but it's a higher ROCE business because the capex required is lower upfront. There's lower risk as well because the lease liabilities are largely linked to the revenue you're going to make. So it's not like you're going to be shelling out lease at a fixed rate. It's going to be at a fluctuating rate depending on the customers that are coming in, and that's why it's a lower risk approach. Now let me talk about how the split works in terms of managed aggregation and straight lease. Managed aggregation, which is the more efficient model of the business, has 67% of seats and 64% of centers. So 64% of the centers are managed aggregation, 67% of the seats are managed aggregation, and therefore straight lease in comparison has a lower or just a 1/3 exposure in terms of both seats and centers. Now let me talk about capex per seat. The capex per seat has come down sharply because they're going towards managed aggregation, and therefore capex required is low. In the capex per seat, it used to be around 50,000 in FY 2023. That's where it seems to have bottomed. The current guidance is 52 to 55,000 rupees per seat. That's the capex. So you'll have to factor that in because there's going to be large number of seats which are going to get added year after year to ensure that this business continues to grow. It may change if the managed aggregation, a part of the business, starts to grow faster or the mix increases with regard to the overall business. So if managed aggregation were to go up, your capex per seat will continue to come down. That's not happened over the last year or so. It's largely been flat, and that's why you're not seeing that capex per seat come down meaningfully, but it's not gone up either. So it's that's how it is. Let's talk about the client mix. Now, in terms of the IT sector, it commands the largest mix to the overall client. It's 45%. Then you have professional services at 12, consumer durables at 8, healthcare and pharma at 8, financial services at 11, construction and others. That's how it's split up. Let's talk about size as well. Now, this is where it gets unique, because your corporate and MNC is 66% of the total revenue mix. So you've seen corporate MNC at 66%, SME at around 20, startups at just 13. Now you would well expect the startup industry to tap in more to some of these new age work models in terms of workspace sharing, etc. But that's a very small chunk of their overall revenue. It largely caters to corporate MNC, followed by SME. So again, a very interesting angle to the way in which this business is. Let's talk about centers now. They've come up with something called elite centers. They have 3 elite centers currently. They target 8 to 9 by year end FY26. This is a target for Fortune 500/200 clients, and they target GCCs as well. So global capability centers, Fortune 500 and Fortune 200 companies are the ones that they target under these elite centers. And again, underlining the fact that their larger focus is on corporate and MNC. So while a WeWork you would perceive as a business where someone who doesn't have an office will just walk in, use the space, walk out, this office space solutions largely caters to a cohort of customers which is MNC, corporate, and they want to continue to drive that. Let me talk about allied services that they've gotten into, because some part of their revenue, around double digit, now starts to come from allied services. So one, you have an office space, but now what you can do on top of it is you can design and build the office space for a specific set of clients. Something like an NSC could well fit that bill. A food and beverage could also be provided on the office space premises. They've started something like an office cafe. Instead of walking into a Starbucks, you can actually walk into an office cafe and have coffee along with completing your work. You also have tech labs, mobility and event management that they do. So some other ancillary income which they can earn from their current business model. So interesting, again, allied services, and that's a space which they want to grow in. So that's the other vertical or vector of growth available to them. In terms of FY26 guidance, they're going to add 39,000 seats this year. I did mention that. They're ramping up on occupancy rates. They're focusing on elite centers. I spoke about that as well. And they're going to focus on allied services revenue. I spoke about that as well. So that's the 4 key focus areas for FY26. But let me bring on board, after a much delayed introduction, let me bring on board Anushi Vakharia to talk to us about the first metric that we'll look at in KYC, and we'll quickly bring up those metrics: income statement, operational trends, balance sheet, cash flow. We'll also look at return ratios. We'll look at shareholding, street cred, along with valuations, and then we'll look at street coverage. So all of those we'll look at. Anushi, income statement.
Right. So Hersh, starting off with the income statement, now what we are looking at is a strong revenue growth. Now it's a 40% plus growth that we are looking at in the last 3 fiscals, and in fact in this FY25 the management had guided for a 30% of a revenue growth, and we are looking at more than a 45% of an increase. So they did exceed the guidance that they'd given for FY25. For FY26 they've set a similar target of a 30% plus growth. So it would be interesting to see how this would pan out for the year coming forward. In terms of where the margins are concerned, 29% was the margin that we looked at for FY24, which moved upwards in the range of 33%. So what's the trajectory ahead? Whether these margins would sustain at the current levels is something that we'll see. Now in terms of profit, this is an interesting one, since the company reported its first profit at the levels of 68 crore this fiscal year. So how the profitability trend continues for the years coming forward, what's the kind of growth that we should be looking forward, is something that we should be seeing. Now if we take the broader picture in consideration, that's the 3-year revenue growth, we are looking at a 67% of a CAGR of growth rate. So continuing on this 30% growth rate is something. On what is the kind of growth expectations for the long to medium term is what we are seeing. In terms of how the key operational metrics have turned out, operational seats have increased, have seen about more than a 40% growth to the likes of around 1.35 lakh this quarter, this year end, which the management intends that there would be similar level of seat additions which will take place this year as well. Chargeable area, we are looking at around 7.8 million square feet as compared to 4.8 million square feet last year. While in terms of centers, now we have seen a steady growth here as well. What was the figure at 160? That has moved upwards to the levels of 230. So that's the overall picture in terms of where the key numbers are, in terms of the headline numbers and the operational update as well. Harsh.
Yeah, so let's talk about balance sheet very quickly. You have equity share capital which has gone up in FY25 versus FY24 because of a fresh issue of shares, around 140 odd crore rupees of fresh issue done. You've seen borrowing also inch down a little bit, but this is core borrowing. Frankly, it's nominal to zero, but what's really standing out within that borrowing number is the lease liabilities, as you can see. Now, lease liabilities becomes important in a business like this because essentially what they're doing is they're taking on property, they are doing a makeover of the property and then they're leasing it out. So it's going to be, of course, a lease which they take on their books and a capex which they do on top of that lease, and therefore lease liabilities becomes important. The exposure doesn't seem too large because the free cash flow that this company does is around 300 to 400 crore, and we'll talk about cash flow immediately after this. But at the same time, you want to be cautious with regard to this number because this number becomes relevant for a company like this. Look at the cash bank balance, not bad at all at 82 crore. There's a decent amount of cash balance there. Mind you, it's a 4,500 odd crore market cap company, so you want to keep that in mind as well. But very quickly on to cash flow, Anushi.
Cash flow, if you're talking about the FY24 to 25 change, cash flow from operations have picked up from 228 crores to 363 crores, while net cash flows also, we are looking at a significant growth here. Of course, the fundraise helping as well. But it's the return ratios which stand out over here. We'll talk about it more. From a 25% of a return ratio in FY23, we're looking at a 62% number. So it's more than a 2x or a 2x of a growth that we are looking at. Now, what has happened over here is, of course, the managed aggregation model that Hersh spoke about earlier, that also aided to this kind of metric that we are looking at. But is this able to sustain is something that we should be asking the management, right? We will. And let's talk about shareholding in the meantime, because promoters currently hold around 20%. You've got a healthy FI investment also of 20% with some marquee investors, especially PEs. DIs also hold around 34% now, and public holds around 26 odd percent. So that's how the shareholding stacks up. Let's talk about street cred and valuations very quickly. Here you go. 1 month performance is up 3%, but really the most important metric here is from the point of listing. Stock is up 63%. So it seems like the management has kept some amount of money on the table for investors. Also, your IPO proceeds have, or rather someone who has subscribed for this issue during the IPO has done fairly well for itself, because from 383 the stock currently sits at 650 in just a matter of just about a year. So that's a very, very healthy return in that sense. So performance has been good, returns have been good. What I would be worried therefore about is possibly valuations, because valuations have climbed. You're currently sitting at around 65 to 68 times price to earnings. Now what you will likely see is that price to earnings multiple fall to around 52 times as per Bloomberg consensus in FY26, and FY27 that will fall to around 33 to 35. So you might see a shrink with regard to the price to earnings ratio, but that's 2 years out. You want to wait and watch as to how this plays out over the next year or two. You might well see this shrink, but execution will be the key. So that's something you'll want to look out for. But what are analysts saying? Overall, it's a positive view that we are seeing 7 with a buy rating in this one, and no hold or sell rating that we are looking at, which brings the upside potential to 45%. So that's a significant kind of upside that we are looking at, right, Hersh? Yeah, absolutely. So a strong upside despite the kind of performance it's had. Let's go across to Amit Ramani, who's the chairman and managing director at Awfis Space, to talk to us about exactly what the company is up to. So very strong growth in FY25. Talk to us about the outlook for FY26, and also tell me
how long will this kind of 30% growth last for? When does growth start to taper for you?
So, Hersh, thank you for having me on the program.
It's a pleasure.
I think we have given clearly guidance for FY26. Around 30% is the revenue growth. The seat addition is going to be along similar lines. I would not want to comment on further growth beyond FY26 because of obviously being in the public domain. But I think what we look at, right, and Hersh, I think this will give you a good perspective, is that if we were to add the similar number of seats in this year, we have now projecting we have 1,35,000 that are live. If I include the under fit out seats and LOI, I'm sitting at about 1,52,000 seats roughly. So I have a visibility of another 30,000 seats already sitting in the second month of the year, right, or the first quarter of FY26. So we believe that even with this level of growth, our FY27 growth is already getting situated with the seat addition in FY26. We sold last year approximately about 53,000 seats, and this is on the back of FY24 where we are only sold 37,000. So I think as we are continuing to add seats, we are continuing to able to keep up the sales process as well, and we feel that that can continue for us for the next few years.
Hey, hi Amit, this is Anushi joining in. You know, what stands out to me in the key metrics that we are discussing is the ROC. Now from FY23, we were looking at a percentage of 25%, which moved to 43%. Currently, we are looking at a ratio of 62%. But want to understand the growth forward. A lot of it has to also do with the managed aggregation model that wherein you've been increasing the mix of the business. But what's the kind of sustainable range that we should be looking forward for these return ratios that are there?
So from our standpoint, we have given a clear guidance that this ratio will remain in this 67-33 kind of range, right? And we maintained that in FY24 in the last quarter, and we have maintained that for all year FY25. If you look at the last quarter of FY25, we added about 73% of our new seats that were added in this ratio, right? So we feel very strongly that we have mastered this model. It works really well. We have done this across 18 cities. We've been doing this for the last 10 years. We have close to about 150 plus deals that are in this model of the total 210 live centers that we have today. So we feel that this model and the ratio will continue. And if that ratio continues, then our ROCE will continue to remain high in the ranges that we have achieved for FY25.
Okay. Just give us some perspective, Mr. Ramani. How long does it take for you to sign a lease and thereafter get a customer?
Yeah. So see, again, the two models are separate and you have explained the model. So straight lease, obviously I can do the lease potentially in a month, right? I mean, there are a few items to be discussed, but in a managed aggregation, that could take me about a month to 12 months, right? Because you are discussing multiple items that go in beyond just the rent and security deposit, etc. So obviously that process takes longer, but from that point, when we have signed the lease, it typically takes us 60 to 90 days to build out the center, because obviously depends on the size of the center, but typically average size of a center being 30,000 would take me anywhere between 60 to 90 days to fit it out up to our specifications. And then typically, if it's a strong micro market, we could see 85% plus occupancy in 6-month period. If it's a bit weaker micro market, then it could take us up to 12 months to reach that stable state, 85% occupancy.
And therefore, is there scope for upside on this occupancy number that you see? Because you're currently at 73, or during the high growth phase, will it remain between or somewhere in the 70s?
So Hersh, couple of things will change. One, when we added on the base of 95,000 seats, 40,000, you're almost adding 50% capacity in new centers, right? Now, when I add another 40,000, let's say, on the base of 1,35,000, my mature centers will be larger, right? So as a result, overall margin improvement will happen because my mature centers, which range at currently at about 84% occupancy for 12 months or more centers, those will become higher as an overall percentage. Hence, the margin improvement will certainly take place.
So how much will it improve by, Mr. Ramani?
I wouldn't want to comment specifically on that, but yes, it will improve. You can clearly see that if you are sitting at blended of 73%, and that moves every percentage that improves. Almost all of it drops to the bottom line, right? Because you're already at 73% blended occupancy, your centers are already covering the operating expense that goes in. Rent, obviously, your minimum guarantee is already stable. So as that improves, almost all of it drops to the bottom line.
Right. So, Mr. Ramani, now that we've discussed about the key positives that are there, I want to understand some of the challenges that the industry might face. Just want to understand in terms of where the competition is currently in India. Want to get a sense on that, even in terms of the supply side, supply which is coming in. What's the outlook here?
So on the supply, see, our model is very different than all the competition. All of this data is available in the public domain because most of them have filed DRHPs, right? So without commenting specifically, our model is 30,000 square feet, right? We look at the network, which is, we have 200 plus centers. We look at the number of cities. We are in 18 cities. You can already see the network effect happening, right? Today, 40% of our clients are multi-location clients, which was 23% just about 2 years back. Our mobility solutions are, which is part of our allied services. You look at the event and engagement that we are looking at, the tech lab piece that we are doing. All of this is a result of the network that we have built today. Second, we have the tiering of the product. We have Elite, we have Office Gold, and we have the Office flagship product. So every type of customer, every type of cohort size, and hence look at the number of clients that we have. 3,000 plus companies that reside with us today and call us, users for their space requirements. So very, very differentiated model. High ROC because of our managed aggregation model. Network gives us multi-location clients and ability to service every type of client. 3,000 plus companies, less than 100 seats is still about 45% of our demand ecosystem. A large portion where almost no branded player today kind of exists. So large focus on making sure that we can service every type of customer, every type of cohort size, and deliver consistently with them, providing all the different conveniences, including food and beverage, event management, technology, as well as mobility.
Okay, elite centers, is it margin accretive for you? And allied services, is that margin accretive for you?
Both of them are.
Okay.
Elite typically is about ends up being about 40% more expensive than our flagship center. Requires a bit higher spend because obviously you are creating a premium product. But if you really look at the absolute value, the payback is much higher because you're charging much higher, right? It might be in terms of margin itself might not show up, but in terms of actual value, it's a much higher spend. So obviously returns are better. Allied services is clearly, I think some of the services like, for example, meeting room is 100% to the bottom line, right? Because the meeting room already exists, or a day pass that we offer to our customer, or day office that we've launched now, or the hub that we have launched a couple of days back. So all of these are 100% margin accretive. Now, obviously, food and beverage, some of the other services range anywhere between 20% margin to about a 60% margin. But yes, overall margin accretive.
Thank you so much, sir, for coming in, speaking with us. Of course, very interesting space, very strong growth in the space as well. It's a pleasure interacting. I want viewers quickly highlight all the rating parameters and basis our KYC rating where we stand. So income statement, thumbs up. Mind you, taxes not paid in FY25, unlikely to be paid in FY26 because of tax losses which have accumulated. You might want to look at that and consider that as well as part of the PAT and the PE ratio that we've extrapolated. But anyway, that's how it stacks up. Also, let's also quickly look at shareholding pattern onwards, how the rating parameter stacks up, and our final rating. No thumbs down on this one. That's the one thing that stood out for me. And 6.5 on 8 is what this one gets. All the time we have, folks, today. Thanks for joining in. From Anushi, myself, everyone who puts the show together, we thank you for watching. Stay tuned. More action on the other side.